What happens when you combine the most innovative, eccentric and charismatic leaders, disruptors and founders from tech, with the pedigree and history of one of the most established institutions within the City of London? The Searching for Mana podcast will be produced in partnership with the London Stock Exchange. I'm Lloyd, the host of Searching for Mana. We're going to be interviewing some of the leaders, influencers and disruptors in the tech space, where I'm going to be trying to dig in and find out what's their mana, their superpower, their magic. Welcome on to Searching for Mana, Jamie.
Thanks for having me.
Pleasure to have you on the show. Really excited and been looking forward to you coming on for a while. To go into just a little bit of an intro, Jamie's managed to, since around 2014, create, what is certainly front of mind as a venture accelerator in the Web3 space. So congratulations.
Survived it.
Yeah, exactly. Continual recurring survivals whilst making parallel progress is the name of the game there. So there's many things that the audience will be really interested in, but just in case anybody wants, the version from you, Jamie, if you could just talk to what Outlier Ventures is right now, please.
Yeah, so today, Outlier Ventures is an accelerator dedicated to Web3 in an expanded context, and we call that the open metaverse. I know the metaverse it was really in vogue, and then it's kind of a little bit of out of vogue. People got very bored with it, but we really do believe in thinking about Web3 in the context of the metaverse. And so much so, we published a paper called the Open Metaverse OS operating system a couple of years back now, before it was hot. And so we're sticking with it. We still think it's an important framing. Maybe we come back to that a little bit later. But to give an example of scale, so we're about 185 investments now, as you say, since 2014, the large majority happening in the last couple of years as we ourselves have accelerated our growth. We're accelerating up to 50 startups a quarter. I think Q4 22 was around about 35. I think we'll probably be about 42 or something like that in this quarter, Q1 of 23. But we have the kind of capability, the infrastructure to do up to 50 if we kind of find the right projects, the right teams, founders. And that really spans the whole breadth of Web3. So there is lots of infrastructure and DeFi in there, but there's also lots of other weird and wonderful stuff that I believe the metaverse takes us into, and that's media, entertainment, music, gaming, but then also a lot of key primitives that I think are still critical to making Web3 usable, mainstream, around things like identity, reputation systems, even kind of positioning devices, new positioning protocols for things like AR and VR. So we really cover the whole gamut. And while some of the startups that we work with will identify as Web3 startups, some might identify as an AR startup or a VR startup that happens to leverage Web3. And I think that's a really important inflection point as this stuff begins to genuinely become a new web paradigm. We're about around about 100 full-time staff at any given moment. I'd say half of those are focused on back office and kind of classic acceleration, fundraising and hiring and go-to-market. And then the other half are highly specialist in everything from token design or token engineering and simulation, tech analysts that might specialize within Polygon or Polkadot, as well as in-house securities lawyers that can think from a jurisdictional perspective, a regulatory perspective, and structuring perspective. So in summary, all of that is when we work with a founder or a team of founders, being a founder's hard, being an early stage founder's hard, being a Web3 founder's even harder, because you've got all these other things to navigate. You've got all these other kinds of risk to manage. You've got business model innovation risk, you've got technical risk, and you've got regulatory risk. And a lot of founders, even later stage and very seasoned founders, are just overwhelmed by that. There's just no way that they will or should have all of those competencies just sat around within their startup. And so we really wrap around them and accelerate their learning and progress to kind of just focus on being a founder and kind of getting that traction, closing capital, deploying it into growth. So that's kind of a summary of what we do at Outlier.
Fantastic. And as you say, a few things that perhaps we come back to slightly later around why you took that narrative around the metaverse and such like. We're just right at the beginning of 2023. And I think it'd be really interesting for the audience to hear from you, Jamie, why, if you're still incredibly bullish around Web3 and the metaverse. And just, I'm sure 90% of the audience who has overtly shown over the last year or two that they are probably had around, the Christmas dinner table, certain questions or debates or conversations around why one might still be 2022, actually had lots of success in the space and progress that you'll be fully aware of and be able to talk to. But nonetheless, there also has been a bunch of trickier scenarios and a lot in the press, really right towards the end of the year with FTX right at the peak of that. So give us, if you will, your bullish confidence on the space still, please.
Yeah, so I'd perhaps untangle crypto from Web3. They're obviously related, but I think they're different. And I think crypto is the thing that drives a lot of the headlines. It's the thing with the big numbers. It's the things with the drama. And really, the simplest way to kind of think about the difference between those two things is, Web3 is the infrastructure, the middleware that makes that infrastructure usable by developers, and then the applications that are leveraging that infrastructure and middleware to be applied to particular use cases, particular markets. And that's really where a lot of the innovation happens. It's where a lot of the building happens. And I think objectively, if you look at the numbers, that's where the momentum and traction is, both in terms of the kind of technology and infrastructure that's being built and the code commits and the usage that's happening of that, the increased usage, the amount of new entrepreneurs and founders joining the space to apply that technology to their domain. And then also the enterprise adoption that's coming through, whether it's in the context of NFTs and Nike and even Meta and Instagram, or Reddit, or truly entirely new startups. And if we kind of focus on that, the really interesting thing is there's a huge the maturity of that stack, that Web3 stack, is just significantly evolved to any other point in the history of Web3 and blockchain. In that, remembering when we at Outlier came into the space, it was pre-Ethereum, and so you really couldn't build very much leveraging this infrastructure. It was all conceptual, and the minute that you tried to apply it to any use case, it would just break. And for a very long time, that's continued to be true. And so there's been lots of workarounds, but also lots of friction in that being applied at any scale to most use cases, both in terms of the cost, the kind of security, the UX, but also these missing primitives, these missing kind of foundational pieces. And so there's a huge, you compare where we are now entering 23 versus this time last year, there's a huge amount of tech that's been built. A lot of that technology is open source. And that's a really important point that a lot of people miss. when they get distracted by the crypto component, just like they did in 2017. Billions was raised to build tokenized systems and protocols. And yes, a lot of it got wasted, but no more than in classic venture. The difference is that a lot of that stuff was open source. It was built out in the open. The learning was collective. Sometimes the code could be repurposed and reused. And therefore, it's just significantly less wasteful. And for me, that's the real power of tokenized systems, beyond them being ways to coordinate distributed systems and allow for greater decentralization, is that it also is a business model for open source. And the more stuff that's open source, I believe, is what's critically important about Web3. And it just is a more efficient way to innovate. And so we've seen huge progress there, to the point now that Web2 giants, as well as large enterprise, established consumer brands, believe that they can begin to experiment and deploy at scale. And I mentioned a few of them at the top end. We can maybe come back to it a little bit later. But that's been almost relentless, irrespective of what's happened in the crypto markets. That adoption, that innovation has continued. And as an accelerator, where we're working typically with seed stage startups, we've had record numbers of applications, quarter on quarter. That's not going away. The quality of founder, i.e., are they a seasoned founder? Have they had exits before? Do they have domain expertise? Have they built high growth companies, revenue generating companies? That kind of quality is just significantly improved this year more than any other year. So I would say objectively, that's really healthy. That's actually the important stuff. And it is continuing to get built, and it's continuing to be invested in. Record levels of venture capital deployed this year into Web3. Now, I'll come back to that a little bit later, because there are now question marks. That has begun to slow down. And I think there's a couple of things at play there. But then if we jump to the crypto part, which of course is which gets a lot of the attention, because of the daily swings and the volatility, because you have the drama of exchanges going bust, or hedge funds being on the front cover of Forbes, and richest people of the year, like almost overnight, and then almost disappearing, sometimes even going to jail. So crypto is where this kind of permissionless 24/7, and by the way, the first global capital market ever, that just doesn't switch off. There are no breaks. And this is where people speculate on the future of Web3. They speculate on the future value of Web3 technologies. And aside from thinking of these digital assets as currencies, more so they can be thought of as commodities. So if you want to leverage these new digital supply chains, the assumption is that there's going to be greater demand for what is digitally scarce commodities. And so this is where people kind of speculate on it. The reality is, are they speculating, leveraging any fundamentals? No, sadly not, right? And it's a great frustration of people actually building things and seeing real adoption on their networks. Everything goes up or everything goes down, usually in tandem with Bitcoin or ETH. They might have kind of their own mini movements. Has there been manipulation in those markets? Absolutely, just like any emergent capital markets. For those people who have worked in Wall Street and capital markets and hedge funds and private equity firms, any nascent market where there's information asymmetry and there's relatively lower forms of liquidity get manipulated. No different in crypto to those markets as they form. But really what's been interesting there is the amount of leverage that got built up in that system through generally very centralized parties. Hedge funds acting in the same way traditional hedge funds have for years, exchanges that are basically managing things effectively through databases, not actually leveraging the Web3 technology that they're allowing people to speculate on. That's a great irony of it all. And so going all the way back to the beginning part of the year with Terra Luna, and the kind of subsequent fallout of that from various entities that were overexposed, all the way through to FTX beginning part of the year. Some link those two events. Of course, FTX was driven fundamentally by what appears to be fraudulent behavior, but was effectively caused by people being over leveraged, and then that fraudulent activity being overexposed. And so, like in any classic financial crisis, there's this kind of liquidity crisis. There's this over optimism in the asset class that's led to this overexposure. And so once again, we've witnessed that cycle happen. We saw it in 2017 with ICOs. We now saw it with this, what could be argued as this maturation of the capital market structure. You're starting to see more active trading strategies and stuff. What's interesting is that what's been happening in venture generally is separate to what's been happened in these kind of actively traded assets. There were a few entities and funds, say like Multicoin and others, who had a hybrid approach. They were both venture and hedge fund. And I think those that kind of straddled more the active side, if they're even still around, had massive capital calls at the beginning of Q4 in the tens of billions, and may never come back. And that has ultimately affected how people look at the liquidity profile of investing at the venture side. So there is a relationship, things come in on the venture side. I think that's increasingly more professionalized. So there's not really any retail speculation in public sales anymore of new networks. It's generally professionalized venture capital. You can argue the pros and the cons for that, but that's just the reality. And then you kind of had the public capital markets with institutional speculation starting to happen and drive a lot of the cycles. And then, of course, all of that sitting within this wider macro environment, which is 2022 was arguably crazier than 21, and who would have thought that would have happened? So, of course, everything is connected, but I do see the crypto aspect is where you get the cycles, the booms and the busts. And honestly, I don't think that's ever going to change. I do think that whole world, especially large centralized actors, exchanges or hedge funds, should have the same regulatory oversight as they do in traditional markets. They should be better integrated into the financial system. So things like FTX don't happen on the periphery of the financial system as they become a greater part of systemic risk in the financial system proper. But that is kind of separate to venture, which has professionalized, where we're starting to see real objective growth metrics. But then there's a lot more to say, but I'll kind of pause there and we can kind of pick either one of those pathways that you want to take.
Yeah, thanks, Jamie. So I think it was almost an interesting vision of what happened if you were able to speculate and trade in fast growth startups and the private markets, which of course you can't really do unless you're a sophisticated investor. This looks like this may well be changing, but it would be some type of rationale as a founder or an investor or someone with a vested interest in a company in its infancy to go down that ICO route previously, because you'd be able to keep control, have a bunch of liquidity. But then there's also another element to it, of which is you'll hear for sure Web3 founders talking about building a company, but also building an economy. around that token, which makes sense in some instances. I'd love to know what your either developed thinking, which you certainly will have over the last few years, but for this current crop of portcos that you have at Outliers, or just broadly around what the considerations would be to consider having your economy in token and or not.
Yeah. So actually, the days of a public sale, big public sale as a fundraising event are over. They're over pretty much end of 17. You could argue EOS was the last, big hurrah. And then increasingly token events, token generation events, TGEs, have become about launching a network where the token has a functional purpose. Now, that's partially true, perhaps, in a lot of the networks that have been launched, in that they might have a very minimal form of utility, governance, for example, on a very kind of narrow amount of kind of voting decision metrics. But on the whole, that's kind of been the shift. And so projects have raised through private sales primarily. And again, that's increasingly become professionalized. That said, in 2020, what are we now? 2023. So 2021, there was still a lot of kind of investment pools, informal investment pools, not DAOs, largely operated from things like Discords, where angels from around the world, typically crypto native angels, were still pooling capital to invest in things called SAFTs, which are effectively as a futures agreement for a token. You get and they function effectively as securities. So it's a promise for a future token. But I'd say as we kind of came into beginning of 2022, as we kind of watched this continued discounting of the crypto markets generally, we went from over 2 trillion to less than 1 trillion. Those people felt a lot less richer, and they had a lot less disposable income in crypto, and they generally also saw a lot more opportunity in just buying ETH or Bitcoin, where it was liquid. There was greater surety that it would still be around, rather than hunting for multiples by investing in SAFs, which were a promise for a token but not a guarantee. And so they kind of dried out, and this is where we saw record levels of venture capital come in and fill that gap. And it very much shifted from a seller's market, i.e., the what called party rounds. You either had to invest within 24 hours, 48 hours, or it would be oversubscribed, you would never get in. And even very disciplined, very experienced VCs were having to play that game. They were not able to perform any due diligence, but they knew that they could make an investment. There'd be a very short time to liquidity, and they'd be able to lock in a multiple. And so even if they disagreed with that as a sustainable way to operate as a VC, the returns were there, and actually they didn't have much of an option if they wanted to deploy capital into the hot projects. But increasingly that went away, and it became a buyer's market where you had the real due diligence by actual VCs. The amount of deals that they invested slowed down, so they were slowing down the rate of deployment, and they also began to look for actual growth metrics. Show me your real hardcore business growth metrics alongside. So that's kind of what happened in the venture side and how people are raising money. Now, if we think about what that means, or what that meant to the advice that we give to projects, for example, about how they navigate that, well, it had a number of knock-on effects. Firstly, I don't think it means that we're not going to go back to a seller's market. There could be an innovation trigger. It was ICOs, it was DeFi, it was NFTs, could be whatever's next, convergence of Web3 with AI and generative AI, for example, could be the next trigger. That could suck a load of money in. The macro environment changes, inflation data improves in the US, quantitative easing starts again, like whatever it is, there could be this new flood of money coming into the space. Everyone feels richer, and we just go back to that seller's market, albeit temporary. But I think that's unlikely. I think given the macro environment and what's happened more generally to venture capital is that fundamentally how people appraise tech stock generally has changed. You can see what's happening with Meta. You can see what's happening with Apple. I mean, across the tech industry, 15% layoffs. And you can really think of Web3 as the kind of risky end, or the most innovative end, depending on how you look at it, of tech and tech stock. And so people are looking, markets are valuing tech differently. They want to see growth. They want to see capital efficiency. If they want to see that in Amazon, they certainly want to see that in other technology companies. If Mark Zuckerberg's pressured to significantly cut the amount of investment he wants to make in what he believes is future-proofing Facebook and Meta with the billions that he wanted to invest into VR and the Metaverse, then something's structurally changed. And that's ultimately the end of cheap money and free money and quantitative easing that's flooded venture capital and seen record levels of venture capital deployed.
So Jamie, I want to ask a couple of questions off that trail, but just before that, because if you hear that, I think it's important for us to hear, like, how was 22 for you? Like, if I read news and if I look at progress, it looks like it was full of, lots of victories. There's like a massive Farfetch partnership, and Outliers keeps on scaling and looks really bullish. But it was tricky times. Like, how are things? Are things okay?
Yeah, so I'll answer that by first kind of completing the thought and the advice, right? Because things are, we've been around for a long time now, scarily nearing a decade in this crazy environment where volatility or wild price discovery is a feature. It's not a bug. It's, as I said, it's this global 24/7 capital market, which for the first time ever is now highly correlated with the macro environment, which means it's a mature asset class, right? Previously, it would just kind of do its own thing. Now it's highly correlated to what's happening in the wider macro environment. And so the one thing for sure is that there will be lots of volatility. And of course, as an investor, that's both a good thing and a bad thing. It's how you manage the associated risks of that volatility. And so because this is just part and parcel of the markets and the industry that we operate in, we've had to build a business that can sustain that. And so a lot of the thinking that goes into our business planning is what we call evergreen thinking. So whatever we do in a bull market, we have to also be able to do in a bear market. And so we get less caught up in the cycle. So in a bull market, if you imagine that we operate in this value chain, and I describe it as us operating at kind of the top of the funnel in a way. The riskiest part of the market is pre-seed and seed, right? So these are projects that may never actually launch a token, let alone one that will have any value, and even more, one that you will actually end up being able to sell. There'll be enough liquidity where that will actually translate into dollars or whatever it is that you would then need to distribute and reinvest. And so if you think about what Outlier is, it is a risk management platform. We help founders manage risk in innovating in Web3, but we also help ourselves, and we're partnerships. So we're made up of, I don't know, near 40 partners now, ranging from smaller angels all the way up to some large institutions and even sovereign funds. And we help our members deploy capital at the earliest stage, discover, filter from this host pipe of startups. So I think this quarter we've done due diligence, well, from Q4 to start to work with about 45 startups in Q1. It'll be about 1,300 startups. And, you know, so we're investing in less than 5% at any one moment. That's pretty much true every quarter last year. And we're speaking to thousands of early stage startups. Early stage startups are risky, full stop. And then they've got all the challenges that I just mentioned around tech, regulatory risk, business model risk. And we now run parallel programs, up to 5 programs in parallel, each with its own thesis, each with its own partners, and each has its own due diligence process. So at any given moment, we're actually performing due diligence across 5 different theses with different partners to get to that kind of top. It's actually around 3% now of the projects that we speak to. And so, you know, that requires a huge amount of specialisms, going back to the 100 people that we've got to perform that due diligence. But it also requires us to do the work that we do, which is when the teams are actually selected and they join the acceleration program, that we really do remove risk or help the founder remove risk in order to execute on growth. And so our business is to operate within risk, within volatility. It is our business to help our partners in the Outlier partnership and founders manage risk at the riskiest part of the cycle. Now, the tension is always when you're in a bull market, and you know, at one point, so in Q3 of 21, we were launching a new token economy every week. And if the markets had held, we would have continued to do that. I think we've got 40 projects out of our 185 that are ready to launch a network now, subject to market conditions or some other variables. Obviously, we're not launching as many tokens as we used to. And so what does that then mean to our business? Historically, we financed our business ourselves through generating profits, returns, ROI on deploying our own capital. So historically, we've not been a GP/LP fund, i.e., we're not a group of GPs that manage LP third-party capital. It's our own capital and the profits that we've generated over the last several years that we then kind of redeploy. So the great thing is we have total freedom as to how we deploy it. We don't have capital calls when the markets are bad. We can make long-term bets, long-term in the context of Web3, multi-year. Often our vesting of the advisory tokens that we receive are multi-year. They mirror the founders. So even if the token was worth, you know, several billion, and we have had that, we've not necessarily been able to liquidate a position, take a profit. And I think on the whole, if you look at all of our assets that are now liquid, we probably sold, you know, less than 5% of those. Yet, because of the returns that are possible from investing effectively at the stage that we operate at, we're averaging about 330x on capital deployed. It means even selling less than 5% and maintaining that very long-term venture-like mindset, decade-like mindset, we're still able to finance our operations and reinvest capital, because ultimately we're a very capital efficient business. The amount of capital that we invest in teams is circa about $100,000. Of course, we have the operational costs of these 100 people that we've got, and they're not cheap. You know, it's in the tens of millions per year. But actually, if we get it right, and so far we have across cycles, I think we've been profitable every year. Last year was the first year we decided to invest in the growth of the business, in being able to accelerate up to 50 a quarter, and continuing that growth into Q1, even though we knew we wouldn't have new token launches, even though we knew our listed and liquid assets were down, 80, 90%. And so last year was the first year we made a loss, and that was an intentional thing. We decided at the beginning part of the year, we knew 22 would be rocky, but we also knew that there are network effects in being the leading accelerator. Accelerators are networks. It made us number one last year by volume. So 185 investments. The closest to that was actually Y Combinator with 110. I think Techstars was about 85. And most of those Web3 investments were incidental, like they were projects that went through their accelerator and then happened to go on and become Web3 startups just by virtue of the amount of startups that they accelerate, thousands over the last decade. They weren't accelerated necessarily as Web3 startups. If you look at our native competitors, Longhash in Asia, who are good friends of ours, or Alliance DAO, they're in the tens. It's like 25 investments, maybe 50 investments. So both the volume of startups we've invested in and the rate of investments in terms of the growth, we're market leader by some size. And I'm pretty sure if you look at the multiples, I don't know theirs, but I'm pretty sure they'd be doing very well to kind of be matching those multiples across cycles. So we're market leader. That gives us network effects, networks both in terms of the startups that we work with, remembering that they're often open source, remembering that they're all contributing or leveraging Web3, the Web3 technology stack. It gives us network effects in terms of investors, in terms of enterprise partners. You mentioned Farfetch earlier. And increasingly means that we're a go-to partner for some of the leading protocols, Polkadot, Polygon, all the way through to brands that want to engage with Web3 at scale. So scale is important, and that's kind of what we chose to invest in 22. However, we did, for the first time, to finance that, have to look at bringing in large institutional investors, some of which I can mention and some of which I can't. Farfetch being one of them, a large listed PLC in the luxury category, providing IT backbone and e-commerce for pretty much 3/4 of the luxury industry. And we've got several more we're going to be announcing over the course of Q1, Q2, where they effectively serve as go-to-market partners. And so there's now bigger emphasis on go-to-market partners. Those go-to-market partners, Fortune 100, 500, whatever it is, they all want established players that can operate at scale. And so far, we're really the only player in town for that. However, the liquidity profile's changed. It's still, I think, going to be, for us, digital assets are going to be, it's different to equity. Equity, if you look at Y Combinator, by far the best performing accelerator globally for the Web2, a couple of decades, actually. They're still looking at best, 7 years to a decade before they maybe get an IPO. And even then, that's a very small percentage that might ever IPO. And they expect a much higher fail rate. I think the average accelerator is about 50% fail rate, like they'll be dead in 3 years, which is better than early stage venture, which is less than 10% will make it. We actually had 90% survival rate across 8 years. And typically we had 6 to about 12 months liquidity where we would begin to have the vesting of a digital asset. So that was great. I'm not sure that's going to continue now, given what I just mentioned about what's structurally changing in wider venture and capital markets, the knock-on effect that's going to have to Web3 and venture, which is also the professionalization of Web3 venture. It's going to look more like classic venture. Equity's back in vogue, which is on one hand a good thing because it means that people are building real businesses. On the other hand, equity has equity-like liquidity. It's either an acquisition or a flotation. That elongates our time to liquidity and profit taking. But we're also seeing a hybrid approach. We're seeing teams are more mature teams now, the ones that are doing better. They have an equity commercial business that they can raise money into that hopefully has growth metrics. And then they have the open sourced technology stack and network. And if they have both of those things, often they've got longer runways on average for us. Over 12 months, and I'd say half of them up to 24 months cash runway. They're able to pause or delay the launch of the kind of network, focus on the revenue generating business, which gives them a wider pool of venture capital. So in some ways, Web3 industry and venture in our world and our business model starting to look a little bit more like classic acceleration, but more like a hybrid. It's kind of the merging of Web2 venture and equity, and then the opportunity and upside that Web3 brings.
Yeah, I love it. And you know, I think probably I'll ask you now. Let me kind of leave it right to the end, but it's a good segue into like, why are you doing this? Like, what's the Hollywood version? You got an opportunity now to, as you say, in 2022, you decided to, you know, kind of build for growth. Where are you going to take that now and, you know, really take that out relatively far? I mean, I think about this type of thing quite a lot because I work with venture capital firms and accelerators and startups and so on and so forth, but nowhere, obviously, to the level of the ecosystem you've created, Jamie. And I think about it from the perspective of, you know, I've kind of flipped a services business into being able to invest into startups I'm really passionate about, making a large impact, which I love. I love that element of it. The actual creation of the services business has largely been a very big pain in my ass. It's like monumentally hard. But actually having had it has been so useful, because then when you see an investment, you're able to bring what in our instance might be one of the most important things, which is the right talent to build out the team who then do a lot of the building. So you've got these core pillars of finance. And when you talk through what you've got and the individuals from those 100 or so, and then being specialists, being able to, you know, de-risk the founder, kind of almost having that accelerated cookie cart successful infrastructure giving to them, it of course is best class in what an accelerator does. So do you think, okay, if there's any competitiveness, which I'm sure there is, like, how's this going to be so fun if I just keep becoming the best possible accelerator in Web3? Do you think I just keep becoming the best accelerator, but it tranches out into innovative? Like, I will start picking up at AI at some point. And at the end of this accelerator's everywhere. It's just the best companies on the planet. Or do you start building this into a full service financing venture play, or other?
Yeah, no, it's a great question. So I think I alluded to it a little bit earlier, which is in a bull market where everyone thinks they're a genius and it's easy to just believe everything's up, and you're looking at this notional wealth or value that's been created by your firm, it's very easy to get distracted, all the things that you could do. And you know, we've considered them all the way to an exchange and a listing platform, market maker, GPLP fund at multiple stages. And we've never quite pulled the trigger. And we chose to kind of just double down on the accelerator, where others kind of have gone off. Okay, we're going to become a DAO. We're going to try and do acceleration as a DAO, or you know, we're really going to use the accelerator just as a feeder to a big fund, and we're going to focus on the fund. And none of those decisions are wrong, but you're adding to the complexity of the business. And so, you know, we've got really, really good at acceleration. Because it's Web3 and it's all emergent, you can't turn everything into a template or a process. I'd say half of it you can, but you need the statistics behind it to know, well, you know, doing A rather than B is statistically important to success, which is why you need scale, you know, which is why for us we needed to be doing at least 100 startups a year, and why we're aiming for 200. It allows us to objectively measure the success of what we do and the advice that we give and how effective it can become. And that's kind of that's the core business. Now, there are some things that you can do that become then additive. The reality is people don't come to work with Outlier for capital. I mean, some of them might, if they're really, really early, they're coming for that 100K. But it's not because we give them money, it's because we make them and help them become more investable. And it's other people that ultimately give them that money. Now, because of the scale that we're operating at and the decision to do that throughout what might be a sustained bear market, that then has a greater capital requirement, the CapEx part of our business, the capital that we invest into startups beyond just the operational costs of working with them. And so we are now actively looking at various GPLP structures with strategic partners, where we have third-party capital that can effectively help better capitalize our business to operate at scale, both in terms of the volume of capital that we deploy for projects as they're coming into the program, but then also doubling down on follow-on rights. Follow-on rights have never been that important to us because we're focused on the token, and the token doesn't get diluted generally. You know, 6% of a token is 6% of a token. 6% of equity could very quickly become 0.5% of equity if it's successful. So now we have this new capital requirement as the market changes, as equity becomes more important. And therefore, there is a real requirement now for us to have a fund. But really the fund, and the fund can deliver great returns, but really that's because it supports our core economic engine, and our core economic engine is the advisory business. And there's nothing that we've ever looked at that gives the returns, consistently gives the returns that we've achieved through the advisory business to subordinate it. But there's lots of other things you look at in a bull market that make lots of sense. You see people making lots of money, have marketing agencies charging 2% of token fees just to do community building, which is in any other world highly commoditized. But in Web3 becomes this premium. They start acting like VCs. But guess what? Market downturn, those agencies are literally dead in a couple of quarters unless they've been very, very disciplined in how they manage their capital. So there are things that come and go with cycles that are great to do in a bull market, but you end up with a load of people you got to fire in a bear market. And so, you know, we look at our value chain, we understand that value chain, we follow how it changes based upon the profile of the asset class and liquidity. But we're pretty disciplined about where we operate in that value chain. As I said, so funds probably really the only thing that actually now makes sense for us, even in a bear market, or especially in a bear market, but also in a bull market. And so we'll kind of expand there, or are expanding there.
What type of size fund are you looking to raise?
So again, we're pretty capital efficient, right? If you look at writing 100K per startup, even if you said, you know what, we're going to be industry beating and we're going to give them 200 or 300K, times that by a couple of hundred, it's still not that much relative to a lot of the other funds that are out there. We don't need that much capital just for the baseline. However, if you then want a follow-on fund, if you want to invest in projects, later stage projects that are growth stage, that might not necessarily go through the core accelerator, but will work with us in a more later stage advisory, which is an area that we've been developing for a couple of years now, then that requires more capital to play at that level. And I think will become increasingly important because I suspect if there is a sustained bear market, there's going to be more market consolidation. We've seen that with NFTs and NFT franchises, whether it's Yuga Labs acquiring other native IP, acquiring rights to an Animoca, acquiring rights, and Sandbox acquiring rights to existing IP and bringing it into the metaverse. Futureverse, which is an investment that we made some time ago, is a roll-up based upon several startups that we invested in that represent a full stack for world building, including some AI components and everything else. And so, you know, they just, I think I can say, I don't know how much I can say, they've closed a large amount of money. They'll be deploying that in M&A. And given equities back in vogue, guess what? There's more acquisition opportunities. There's going to be more consolidation. And you could see that trend even with FTX, you know, where he was being pitched as the JP Morgan of crypto, where he was bailing out projects that were struggling with capital. You know, that goal was market consolidation. It wasn't charity. And I think we're going to see more of that the more sustained the bear market is. So, you know, we need to be able to support our projects to be better capitalized, to be the acquirers rather than the acquired. Acquired might work for some founders, but it doesn't really give the full return profile for either investors or founders that they would want. That then comes into, I guess, our big long-term vision for the next decade. You know, our goal, it's not apples for apples, but is to be the Y Combinator for Web3 and the Metaverse. We believe that is an even bigger opportunity than Web2, because more stuff is going to be happening digitally. The digital economy as a whole is going to grow and expand. And, you know, I think that we're quietly confident that it's not, will we make money from that? Will we make an inordinate amount of money that relative to anything else we could be doing with our time? It's really like how much, to what extent? And so that's not really a core driver for us. We've got really good historical data, as I said, 330x across cycles, you know, profit taking year on year. Yes, there are new challenges ahead. Being a company of scale, 100 plus, is very different to being, you know, 25. As you said, services business is a people business. Notoriously difficult to scale rather than a software company. But I think we're in a really good place now. And as I kind of look forward into the next decade, I'd say it's our opportunity to lose. And I think, but I don't think we need to do anything differently. I think it's repeating this kind of quite laser-like focus on what is the core business, how do we stay evergreen, how do we help our portfolio stay evergreen, albeit, you know, maturing, you know, how we finance ourselves as a business. You know, ultimately, to your question around, do we stray outside of blockchain and digital assets? I don't think so, because I mean, we've always had a thesis, the convergence thesis. We published a paper in 2000 and let's say 18. It might have been earlier, where we said you can't think about blockchain in isolation. You have to think about it as it converges with big data, IoT, and AI. And we produced loads of thought leadership on that. Some of our earlier investments were actually into the convergence of IoT and blockchains, which was IOTA. It was AI and blockchains, which was Fetch.ai. It was big data and blockchains, which was Ocean Protocol. Secret Network, similarly around off-chain secure computation. And we've got several others in data unions and data marketplaces. So thinking about Web3, including technologies like AI, is not new for us. In fact, you could argue we were probably a bit too early in the investments and the thinking that we made. And interestingly, I'm just in the process of writing our thesis for 23 and beyond. And I strongly suspect that AI will be, and how it interacts with Web3 and digital assets, how it interacts with DAOs, how it's owned, how algorithms are owned, how data sets are owned, how the value from that ownership is distributed, how the economics of something like OpenAI with its kind of huge compute requirement, how do you serve that in a more distributed way? How the output of generative AI as assets, digital assets and objects, how they are monetized, how royalties are managed, how they can be recombined and recomposed into experiences. I see the only way for that to scale in something that isn't complete dystopia is Web3. And so a big part of our forward-looking thesis is slightly retrospective. And I don't think it stops there. You know, there are other technologies which we were talking about, the convergence of Web3 and blockchain years ago, that haven't quite happened yet, that I believe will, like 3D printing. You know, 3D printing's kind of died a bit of a death as an area that people are interested in. But at some point, you will need to think about how you manage IP in a distributed way so people can produce at the edge, produce objects at the edge. I'm almost sure that's going to be on Web3 technology. Now, is that going to be next year? Probably not. Is it going to be in 5 years or 10 years? Who knows? But this is where it's really important to think about. We are the Web3 accelerator. We're effectively thinking about the next web paradigm. DeFi and stuff like that is just the beginnings, like very crude beginnings of what's going to be possible with this. And that's why we always come back to this open metaverse thesis. It's when you go beyond what Web3 is today, which has been quite narrow. It's been about money. It's been about capital markets. It's been about running very basic logic on chain. And you think about it powering the future of media, entertainment, industrial supply chain. You know, it's incredibly expansive. And so we can go wherever that takes us, because ultimately what we're helping startups do is to think about the fundamentals of that new paradigm. And then we work with a go-to-market partner like a Farfetch in the context of applying that to luxury. But this year we'll be doing a d-commerce program, which is the future of decentralized commerce, with a very large global retailer and some of our existing portfolio. We're thinking about refi, regenerative finance, well beyond energy, and thinking about regenerative systems. So that's the cool thing about this job, is that you never get bored. You know, I've probably got ADHD. I'm perpetually looking for the next thing to stimulate me. And I have the great luxury of working with 50 new founders every quarter who are just taking us into weird and wonderful spaces, educating us as to how this could be applied to a new domain that I have no, you know, personal prior experience to.
Yeah, absolutely fascinating. And that's really useful to hear how you describe that into the metaverse thesis. When you write the 23-24 thesis, will you publish that?
Yeah, so we always do it openly. So we don't always do it annually. We normally do it when we think that there's something significant to say. So the last time we did it was this time 21. Kind of locked myself in a room, just coming out of Christmas for 2 weeks. Started to speak to our portfolio, because we've got this amazing brain trust in our portfolio, let alone people within Outlier, and then of course our wider network, and just synthesize what they're thinking about, what they're talking about, and try to put it into thesis form. The great thing about Outlier is because we speak to thousands of startups who are often at the beginning of their journey, it gives us a 6 to 12 month window on the market just by virtue of doing what we do. And because we speak to so many, it's pattern recognition. It's not like some geniuses in a room, you know, with a crystal ball. It's just going, okay, well, this has been mentioned this many times versus the last quarter. This is where they're looking at applying it. Probably a thing. Let's test that, validate that with some of our portfolio who are more mature and perhaps directly or indirectly working in a similar field. And then we try and synthesize that. This is, and I think prior to that, we hadn't done one in 4 years. But now is a really important inflection point for two reasons. And again, I'm perhaps even spoiling it for myself because I haven't managed to lock myself in a room yet. My daughter's still not gone back to school. And I'm still only just stopped eating sausage rolls for breakfast over Christmas. But I suspect it's going to have two parts to it. I'm not sure quite yet the emphasis, but one will be the metaverse, the open metaverse under attack. Everything from FTX through to new regulation that's coming through, MiCA in Europe, what is still a very politicized debate around crypto in the US, the connection of your Web2 social graph on things like Instagram with your wallet and your financial information in crypto. Is that a good thing or a bad thing? What does that mean? All the way through to what I was just alluding to there, which is the end game that fascinated us several years ago, which is, well, what happens when Web3 does or doesn't converge with AI and the advances in AI? And I think everything that you saw with GPT or Midjourney, the advances in how AI is now being applied in a very real form for the majority of people. What does that do to search and search engines? What does that do to creative industries? What does that do to industries beyond that? And who owns that? Like, is OpenAI actually open? Well, not really. It's behind it's walls, a walled garden. It's through an API. You pay for it. There are VCs in there. Currently, they're capped in terms of their return profile, but they can change the rules of that game overnight. They can say certain people can't use that API and certain people can at a certain price band for certain things. And these are things that if it goes in the wrong direction, it's going to be way too late. If you think about all the people playing with these forms of OpenAI at the moment, you are training somebody else's algorithm. And because it's fun and it's visual, millions of people are doing that now. But ultimately, who benefits from that? Well, it's free now whilst you're training it, but then maybe it's not going to be. And so I think very quickly, all this infrastructure we've built around how you monetize open source technology, how you can make sure it's owned in a more distributed way, how you can make sure it's governed through things like DAOs. All of that infrastructure is going to become very, very important to AI. And ultimately, AI is the end game. I personally believe we're heading, and this is why we made our investments into Fetch.ai many years ago. I think it's maybe our fifth investment, some of the early DeepMind team. Their vision for the web is an agent-based web. So where we have one or thousands of agents representing us carrying out economic activity through AAs, autonomous economic agents, but they are sovereign to us as a user. They're not owned by a platform. And so I think AI in the context of the user, the platform, the terms of usage, the control, permission, data privacy, these are all things that are going to become increasingly important. So that's probably the second part of the thesis update, which is actually a bit of a retrospective in a context of more recent AI advances.
Okay, so the big question, Jamie, is what would you say your mana is?
Well, I'd say ultimately it's probably communication. And I say that because a big part of what we do with founders, or at least how I personally interact with them as an area of advice, is helping them tell their story. And I didn't actually, until it came to Outlier, I didn't really realize how difficult it is for most people to communicate. Most people feel very uncomfortable with attention. They struggle to communicate what they're thinking in a coherent way. They struggle to have that communication connect with people emotionally. And I realized, A, how important that is, B, how difficult it is to train people to do, but it is very possible. And that ultimately, as human beings, a huge amount resides around storytelling. As a tribal species, as social species, and it seems that that's what I'm good at. Good at communicating. And so if we come back to the thesis, for example, most of those things won't necessarily be my unique thoughts. There'll be things I've heard that I will put into a narrative that makes sense. How I personally writing things down, I find, and rereading them and rewriting them over and over again is a great way to perfect how to communicate before you then verbalize it. But then after that, it's exposure therapy. So as a kid, I was actually quite a shy kid for some time. And there had been moments in my life where I'd burnt out in my early years when I was doing startups. And the first thing that would be affected would be my confidence and ability in communicating, at one point quite severely. So kind of relearning that ability to communicate confidently has been something I've done not once, but multiple times. And I think if you were to answer the question, what is your mana? It has to be the thing that if you took it away, you would be a lesser person, a substantially lesser person, less happy, less successful. And so if you took my ability away to communicate, that would probably be the worst thing. So I would say it's communication.
Be on the phone to Y Combinator and say, go take communication from Jamie.
Exactly.
Yeah.
Productize it.
Amazing. And so important. And a whole different podcast on how OpenAI is coming at narrative. And you have a podcast, Jamie, and we share that in the show notes also, so people can listen to you on that podcast. We've talked about, which is what we normally conclude on, your Hollywood version, which is amazing, of Outliers. And I've taken a lot of your precious time, so I really thank you for that. The only thing really I think would be lovely to finish on is if there's a particular spotlight you wanted to put on any one of your portcos or particular trend in the space that you're super excited about, because I'm just going back to that point I raised. I know I talked about crypto in preference to Metaverse Web3, but again, it does feel like, we've been in a really tricky time, and I think confidence is important, and your mana is communication. And so if you wanted to take the form of communication through some type of case study to make us bullish, then I'd love to conclude on that, please.
Yeah, so look, I mean, it's always, we've got 185 investments now, so to focus on any one of them is uncomfortable and unfair. But maybe to kind of just speak to the kind of previous themes that I talked about, revisiting some of the themes that we were investing in several years ago. There are a couple of projects that I would reshine a spotlight on, because I think A, they're probably now more relevant than ever, but B, they survived. They were probably too early. Most projects that are too early don't make it to be relevant. They don't survive that period, because we're talking about multiple years. And these projects have, and so I think it's probably fair to give them a shout out. I think Fetch.ai is definitely one of them. I mentioned them earlier. They built a protocol within the Cosmos network in the end to allow for agent-based systems, AEAs, autonomous economic agents, who can operate on behalf of users. So they're effectively sovereign agents versus platform agents. And between themselves, they can form complex systems, they can form capital markets, they can optimize those markets. That's definitely the future. They're the closest thing I've seen to an attempt to do it. They did it several years ago. They're still here. And I think people should look at them. They're very relevant, and Live Network. The other one is Boson Protocol, again, not as old as Fetch.ai, but one of the first startups we accelerated in a proper accelerator when we began running that 4 years or so ago, and that's Boson Protocol. And again, they were born in a crypto winter. They've survived, shipped, and are alive now. And they've effectively built a d-commerce protocol, a primitive around physical to digital redemption, but they're working on much more than that. And it's this idea about how do you unbundle e-commerce and allow it to become composable in the way that DeFi is.
Yeah.
So I think they're super interesting. And e-commerce is increasingly relevant. And I know they've got some really exciting partnerships they're going to be announcing shortly. And then maybe thirdly, quite closely linked to Fetch.ai is Ocean Protocol, in that they similarly survived since 2017, the top, fast forward now to 2023. And they built out a lot of the infrastructure that allows for data marketplaces, decentralized data marketplaces. And we've had many other investments that have built on top of that to allow for things like data unions, where you can aggregate your user data, you can pool it with other users' data, you can permission how that can be monetized or used. And ultimately, that's what's going to fuel AI and communal owned forms of AI. So I think they're all three interesting parts of the stack that we've invested in, the Web3 stack. They're mature projects with mature networks. I have a high confidence that they'll still be here in several years' time. And I think they're probably now more relevant than ever.
Love it. Thank you so much. Really enjoyed the conversation, Jamie. I hope we have more moving forward. There's so many different ways we could take the conversation, but I know your time is precious and you need to write that 23 thesis, and I look forward to reading that. Thank you so much for coming on the show, sir.
Thanks for having me on. It's been a real pleasure. Hopefully my daughter's still entertained with Roblox in the other room. I'm sure she is. 2 years, 2 hours of playing on centralized Metaverse platforms. There you
go. Fingers crossed. Fingers crossed. Yeah. Amazing. Thank you for joining us on this edition of the Searching for Mana podcast. We hope you've enjoyed it and hope to see you again next time. Please subscribe to our YouTube, Spotify, or iTunes to make sure you receive all the latest episodes as they are released.